session on energy, entrepreneurship, and finance. There are changes going on in the private securities market which are allowing private institutional investors such as family offices, sovereign wealth funds, pension funds, private equity, venture capital, for example, to gain unprecedented access to debt and equity opportunities locally and internationally. Today our panelists will discuss some of the challenges that they see in the private securities market and why some projects succeed and why some projects fail. So first up, we're honored to have Ambassador Bob Perry, Ambassador Bob, who's a founder and managing director at the Stevenson Group, which is a group of retired ambassadors U.S. ambassadors from around the world. Then next up, we have Brent Taylor, who's a partner at Sequoia Investment from London. And then we have Robert Fenwick-Smith, who's a founder and managing director at Aravaipa Ventures here in Colorado. So I'm handing the floor over to Ambassador Bob.
Good morning. It's an honor for me to share this panel with Tina, Robert, and Greg after attending several of the stimulating sessions yesterday. Tina and I met about a year ago when I introduced her and her partners at Castle Placement to developers of a large waterfront project in Lagos, Nigeria. They were seeking financing in the U.S. capital markets. So I drew upon my experience as an American diplomat and then 10 years with the Corporate Council on Africa, which was promoting trade and investment between the U.S. and Africa, and then my current stint with the Stevenson Group. I saw the potential in creating this world-class, multi-billion-dollar project in the largest city in Africa, Lagos. I sometimes say Lagos is New York on steroids. And so I understand that the developers and Council Placement are working on now on the terms for the capital raise, and I hope it goes well for mutual benefit. Another example of the Stevenson Group's efforts is helping Blue Roo, an Australian solar tech company supported by the University of New South Wales, to raise funds in launching a new solar panel that's more efficient and more cost-effective than some of the other products in the market right now. I'm sure they will do well in Australia, but we will help them into the U.S. market as well as select countries in Africa. The key point here is partnership for development. That means building bridges between project developers, government agencies that provide concessions, and finance firms that offer equity and debt financing, expecting a good return for their investors. I'll focus a little bit on the USG agencies that facilitate American investments in projects outside the U.S. The U.S. Trade and Development Agency, the U.S. International Financial, bring it up, U.S. Trade and Development Agency, U.S. International Finance Development Corporation, and the U.S. Export-Import Bank. The U.S. TDA promotes U.S. exports to advance economic development in developing and middle-income countries. It connects foreign project sponsors with U.S. manufacturers and service providers to promote exports for U.S. companies. It conducts reverse trade missions to bring non-U.S. decision makers, both government as well as corporate, to the United States to meet with companies and manufacturers as well as other service providers so that they can understand what they need from the U.S. to meet their national development goals. It works with U.S. private sector in project design to promote the export of American goods and services. It offers grants directly to overseas sponsors who select U.S. companies to conduct USTDA project preparation tasks. This includes the feasibility studies, technical assistance, and training programs. USTDA's criteria for feasibility studies favors U.S.-based companies that are more than 50% owned by U.S. citizens or U.S. legal residents. In October, USTDA just announced requested proposals for a feasibility study for an integrated solar and energy storage project in Thailand. Maybe more relevant to this group, USTDA also has a gas infrastructure exports initiative which connects American companies to export opportunities in the gas value chain in emerging markets. USTDA has supported projects in 71 countries over the past 2 decades that has generated more than $7.4 billion in exports. Now I'll turn to the U.S. International Development Finance Corporation, which was recently created by the BUILD Act, which was enacted in 2018. The focus there was to merge the Overseas Private Investment Corporation, known as OPIC, and the U.S. Agency for International Development Credit Authority to provide a more user-friendly institution to support American investment overseas. The goal of the Development Finance Corporation is to stimulate American investment in emerging markets that may not have been favored by Americans and which have therefore turned to state-directed investment from authoritarian regimes. The merger between OPIC and USAID doubled the lending cap from $30 billion to $60 billion. It continues the loan guarantees and various types of insurance that are important in doing projects outside the United States. It also empowered the new Development Finance Corporation to make equity investments in these projects. It also offers local currency loans, first loss guarantees, and small grants to reduce risk. The Development Finance Corporation offers a preference rather than a requirement that it be U.S. investors, so it makes it easier for U.S. groups to then get partnerships with foreign investors. Next is the U.S. Export-Import Bank. The U.S. Export-Import Bank is the export credit agency of the U.S. government, which generally operates under the guidelines of the OECD in governing how export credit agencies operate. It finances transactions that commercial lenders decline due to political or commercial risk involved. EXIM provides a variety of loan guarantee and insurance products to support the export of U.S. goods and services. The EXIM Bank, which was established in 1934 by executive order and later authorized by Congress, has been targeted by conservative members of Congress over the past decade for being a taxpayer subsidy for large corporations. To make its point, Congress has refused to approve board nominations, which then limited EXIM's lending authority to $10 million per transaction. The major impact on this was on aircraft sales and power plants. I served from 2010 to 2013 on the Africa Advisory Board to the EXIM Bank, so I had a sort of inside view of how the restriction on a board quorum affected the bank and how it operates. The bank has an active program of supporting small business, which requires a lot of marketing of its services to businesses that want to export products. Had a lot of experience with a member of the Corporate Council on Africa, Acro Bridge, which exports steel bridge, manufactures steel bridges in New Jersey and exports them to foreign markets. In May of this year, Congress approved the administration's Ex-Im Bank board nominations, creating a quorum that allowed the bank to approve large transactions. As a result, in September, the Ex-Im Bank authorized a direct loan of up to $5 billion to U.S. suppliers for the export of goods and services to the Mozambique LNG-1 financing company for the development and construction of the LNG plant in northern Mozambique. ExxonMobil is a leader in this $30 billion project, which also includes Eni of Italy, the Korea Gas Corporation, and China National Petroleum Corporation. ExxonMobil awarded a $3.7 billion EPC contract to a consortium including JGC of Japan, Fluor of the US, and UK-based Technip FMC. The investment in Mozambique's LNG resources exceeds its current GDP and has the potential to significantly transform its economy and create diverse investment opportunities for national development. It's an opportunity for investment in agriculture, infrastructure of all types, renewable energy, and tourism. Any plan should include extensive dialogue with local stakeholders and a commitment to training to meet their needs. That's how you create win-win deals. Thank you.
Okay, next up is Brent Taylor. We'll have the Q&A at the end.
Bear with me while I see if my technical abilities are up to getting my presentation on. Great. Well, I'm honored to be here. I've spoken with so many hyper-intelligent, hyper-educated people. It's somewhat intimidating to be up here. But it's exciting for me because that's exactly the sort of support that we need in the work that we do making investments. I'm one of the 4 partners at Sequoia, no relation to the California venture capital firm. We are London-based, and that's where the company is. That's where I live. You can probably tell from my accent. I'm American originally. In fact, I'm from Colorado originally. We started Sequoia in 2010 because we could see that after the global financial crisis, banks were coming under pressure to change their lending practices. And in Europe, the banks were funding more than 90% of infrastructure investment, of the infrastructure debt side. Whereas in the US, as most of you might be aware, the public sector is involved and there's tax-exempt financing. So we could see that there was an opportunity specifically in Europe, but it's broader than that now to fund private infrastructure. The types of infrastructure that we fund, demonstrated by the range of projects on our sort of cover sheet. This is our standard page that we use. We do, out of the 8 sectors that we're involved in, transportation assets, accommodation, which for us is student housing, hospital, specialist care, and so on, utilities, power, and renewables. Those 3 clearly relevant for this conference, but I think it even spreads into transportation assets, for example, where we're funding assets that, as we try to play our part in decarbonization, will be dependent on the sorts of technologies that are being discussed at this conference. The reason that infrastructure and infrastructure debt has become so relevant to investors is that it's a massive asset class, very diversified, And the capital investment needs are massive. I mean, trillions is required to meet our needs for infrastructure, and in particular on the energy side. And investors like the asset class because it's not correlated to the business cycle. So if they're investing in corporates, either stocks or bonds, the demand for these sorts of assets is less subject to economic trends and is a much more longer term prospect. And when you look at infrastructure debt, as investors become more aware of the credit characteristics, it's offering them a higher yield than government bonds or even corporates. And behind all that, if you're looking at whether you want to go into equity or debt for these projects, debt is offering a stable return. You still have an equity cushion behind you. So the first losses will be absorbed by the equity investors. And for that, they're rewarded with a higher return. I asked one of the guys on my team, Keeler, to put some good energy photos in here. It's clear that Keeler is really good with spreadsheets, didn't go to art school because the layout of this page is a mess. But we are financing within those three pockets, obviously renewables, so wind, solar, we have some geothermal, some hydro. I love this. We recently closed this transaction. Very old, low-scale technology. I think some of these dams were from the 30s, but this is in New England. But what I love about it is the guys that own this asset, when energy prices are high, they open the spigot. When energy prices are low, they close it off. It's the simplest thing in the world, but it's a good concept. But we're also looking at we've been financing more what we like to call grid enhancement. So we're very supportive of renewables. A lot of renewables gets done at lower yields than we need to meet our investor requirements. But what we can finance where we're achieving our yield, sometimes on a subordinated basis, are peaker plants that, while they're gas-fired, are critical to maintain the reliability that we need to balance the grid. So we feel that still counts as doing our part to try and shift the world to a less carbon-dependent environment. We're also looking at battery storage. I've got a meeting next week in London with a company that's proposing to build 50 megawatt grid scale batteries, and I'm really hopeful that they're going to tell me that they've now got enough equity backing that it's something that fits within our risk profile, because I think that's a very exciting development. But we already finance a rooftop solar company that has recently won a grid scale battery contract because they control enough batteries on people's rooftops that they could do a 20 megawatt contract. So we've sort of indirectly done our first battery transaction. But we're looking forward to moving with the industry into the new forms of energy, and that's why it's exciting for me to come here and hear these academics discussing how we can improve the economics associated with some of these projects to achieve the decarbonization that we hope to achieve. The basic structure of most of these, and forgive me, this is pretty basic, but hopefully it's a little different from a lot of the academic papers you've been seeing. But the equity investors actually own the project, and for us, that's about 35% of the capital of most of the projects that we go into. There are types of infrastructure where if it's it's generally called availability payment based, but if the government is responsible for making the payments, you can gear that up to 90% debt, 10% equity. But we're looking at riskier projects, 30% 35 is typical for us. So what we do as lenders is come in to meet around 65% of the capital required, typically to build a project. So if we're doing a project financing, it'll be a single project. The revenues for that project come in, pay the operating cost, pay us the interest on our debt. If it's an amortizing structure, they'll be paying down our debt just like you would a mortgage on your house. And then the excess, whatever's left, then belongs to the equity investors. Very critical for us to have a competent operator. Many times the operator is a subsidiary of the equity or in some way linked to the equity investors. So these big projects will be a consortium of many investors, just like Professor Perry's project in Mozambique. That's astounding, a 30 billion project. So obviously that's got a lot of cooperation from companies around the globe. Japan, US, and the UK, I think, are the contractors. When we're out raising capital to invest in these projects, what we're telling investors is that infrastructure debt is very resilient. We really value our diversification. So I often get the question, are there any sorts of assets that you like? I said, I like all of them because I want our investors to be protected against changes that will render one or another class of assets riskier. But infrastructure, compared to corporate bonds, the graph at the bottom there shows ratings volatility. Infrastructure is a much more stable asset class, and they're defensive. So utilities, energy needs, it's less impacted than corporate bonds, certainly from corporate cycles. The other thing that's not immediately obvious, if you look at the graph on the upper right, this is a marginal default graph, and what it means is if your project hasn't defaulted this year, how likely is it to default next year? And a typical corporate increases in default probability. So when you make that loan to a company, so it might be a utility in our case, corporate loan, you have greater visibility in the first year of the company's prospects than in the second and the third, and that's shown in the dashed line there, which is corporates. That's increasing every year. So even though a corporate is less likely to default in the first year than an infrastructure loan, you can see in that graph that those cross by about year 5. The solid line is the infrastructure loan experience. This data comes from Moody's, which has been, I think it's now 33 years of data. It's covering something like 60% of the project financing done globally. So it's a fantastic data set. And the infrastructure line, as you can see, declines, and that reflects for most of these projects, there's construction risk in the early years, which is a little riskier than the operating period. But every year, as that project gets bedded down and the operations get known, also a lot of these have amortizing debt, so the debt burden becomes lighter over time. Every year that project doesn't default, it becomes less likely to default. By the time you get out to year 7 or 9, it is not going to default. I mean, it'd be very unusual. So this is something that isn't immediately obvious to investors, so you can imagine we use this data all the time to convince them that in addition to their corporate portfolio, they should be coming into infrastructure. Also, there's a higher recovery rate, and that's another not immediately obvious thing, but when an infrastructure loan goes bad, because you're secured over physical assets, but more importantly, contracts that make the recovery rate significantly higher than what you would get in a corporate that made some bad decisions and ran itself into the ground. Infrastructure debt does have a higher yield than corporates. Given the audience, I won't go into that, but it typically, because it has been sort of a relatively new asset class, we're still able to get an attractive premium. I think I would just wrap up here by saying that the sort of projects that we're looking for, our fund is a higher yield fund. So when you look at the investment grade financing, LIBOR plus 100 to 250, my investors wouldn't thank me for putting them into that. But we're looking for LIBOR plus 500 to 700. Relevance of that to a conference like this is that we're looking for the nascent technologies and emerging projects that can't finance themselves at LIBOR plus 100 to 250. So my interest in coming here and speaking with people is finding whether it's battery storage, other sorts of demand side response for large-scale electricity users. Those are the sorts of things that excite me. And I like to say that we're financing the infrastructure of today and yesterday. So how you got to work this morning probably was similar to how your parents got to work. I want us to finance the infrastructure today and tomorrow. So what is it that your kids feel entitled to? And I want us to be financing that. So they want secure data. They want to be able to use their phone anywhere in the world. And they want it powered by carbon neutral sources. So, they're becoming more and more aware. We have Extinction Rebellion outside my office on Oxford Circus. It seems like every other week, constructing something, putting a Christmas tree up, whatever, blocking traffic. I think the next generation is going to insist that these things that they want, the ability to use their phone anywhere, is powered by renewable sources. I'm going to stop there, and we'll do questions, I guess, at the end.
Okay, my turn to play technology here. this? Hey, I managed to use a non-Mac. This is quite impressive. Ta-da. Okay, so my name is Robert Fenwick-Smith. I'm the opposite of Greg, meaning I'm a Brit living in Colorado instead of a Coloradan living in thing. Tina did quite a lot of research to find that combination. That was really hard to find. I guess I'm also the real cowboy of the group here, meaning I'm in early stage where we basically do legalized gambling, and I'm just going to explain a bit of that to you. So, I love this sentence from Mark Twain. I was seldom able to see an opportunity until it had ceased to be one. And so that's the space in which, as VCs, we play. We want to see those opportunities before they disappear or before they become mainstream. So that's the fun, exciting part of the job. If we look at what is early stage investing, VC investing, it often means we don't know what the product of the company will in the end be. It's in a nascent state. We call them pivots, and that means that generally the product changes. And I can say in my portfolio, none of the companies is actually selling today what I thought I was investing in at the beginning. So, and the markets obviously go with the product. Margins and profits, you're so early you don't know what they'll be in many cases. So a lot of unknowns. Normally it's equity. There is the risk is very high, and there's no collateral. So when Greg before talks about recovery, in our case, recovery normally means zero, meaning if the project goes wrong, we lose all our money. It's pretty binary. So it's high risk, high potential return. I specialize, so it's just here's some more data on things. And the shocking one is that, we expect failure. We expect 75% of our projects to fail. So as opposed to Greg, where he's horrified if 10% fail, we go in it, and our investors go in it knowing that we'll make, in our case, we made 11 investments. 6 of them are still active. We've exited 2 profitably so far. We've had to shut down 2. We distributed 1. So that's why people have portfolios. So that's one of the reasons why when I talk to people, and there's a lot of angel investment opportunities in the US today, and I look at people and I say, yeah, you could do that. But in reality, the type of investments you're looking at as an angel only makes sense with a portfolio approach. Meaning if you're going to be an angel, you have to do 10 angel investments. If you're just going to do 1 angel investment, that's heretic from just a statistic point of view. You have to take those odds and you have to play the numbers. So now what I am first and foremost is a clean tech VC. So I got into this because I was passionate about climate change and wanting to do something at the grassroots level to be able to help us battle that through advances in technology. I know there's other ways of battling it, but one of the ways, as humans, we've proven over the last 50 years, we're pretty good at solving things with technology. So I'm sure it's one of the elements. Now, the first wave of clean tech VCs happened from 2006 to 2010. We launched in 2008, so we're kind of part of that group of people. Now, they did horrifically. They basically took $25 billion and lost half the money within about 5 years. So yeah, it's not a very good asset class. If Greg probably is saying that, how heretic can you be to be in this business, yeah? But you have, if we want to survive climate change, we're going to have to come up with new technology. So as far as I'm concerned, there's no choice. Someone has to do this work, and yeah, I enjoy doing it. We did a few things differently, meaning a lot of those initial investments failed because VCs were coming from tech, meaning, software and hardware and computer stuff, and they were used to cycles where you invest, and 5 to 7 years later, you get your money out, multiplied by 10. The problem is the gestation time for clean tech just doesn't work. A lot of it is real stuff, real plants, real hardware. There's a number of software solutions also, but generally speaking, where with an app, you can upgrade your app every week, or the development cycle is a week or a month. when you go into some of the harder problems like clean tech, the development cycle, the time of each cycle is normally a year to two. So, if you build an electric powertrain for a vehicle and you want to do the next generation, that's going to take a year to 2 years to do. So that those cycles are much, much longer. And that's the main driver why the 5-year horizon is heretic in clean tech. So we started the fund. We were the first fund that said, no, this is going to be a 15-year exercise. We're 11 years into it now. At this stage, people actually agree with us. At the beginning, they disagreed, but yeah, we were right on that one. We do a lot of helping our portfolios, companies raise money. I never knew that I was going to spend 80% of my time fundraising for portfolio companies, but that is one of the realities of this early stage. So we've helped raise about 160 million. What that check hides is what that figure hides is, whereas Greg raises them in millions of dollars chunk. Our average check size over that 160 is $250,000. So you can see how many checks we had to get to those kind of figures. The clean tech has the reward, and we see it in the investor category. A lot of the investors we attract are what are known globally today as impact investors. We attract people who want a financial return, but also want to do something to make the world a better place. And that's kind of, those people, by the way, are amazingly patient investors. So that was something we had no clue at the beginning, and we've learned. Now, just a couple of examples of companies. One of the companies I'm involved in is Lightning Systems, and we do electric powertrains for commercial vehicles. And here the challenge is, yes, someone has to do this, because let's be clear, without Tesla and the VCs who put the first $1 billion into Tesla, we would have virtually no electric vehicles in the US today. Yes, GM would be toying around on the sides, but they wouldn't be making half the investments if it wasn't by being spurred by Tesla. And today we're doing the same thing with Lightning on commercial vehicles, because there's one thing that very few people realize here is, yes, we will probably sell in the U.S. this year in 2019. There'll probably be sales of about 500,000 electric cars. So how many electric commercial vehicles will be sold this year? None of you will guess, so I'll put you out of your misery. About 1,000. And at the same time, when you then go and look in urban centers and you say, where does the pollution come from? Where do the health hazards in big cities come? They come 40% from commercial vehicles. So addressing this, and let's be clear, the OEMs have nothing to win in doing it. They like the current status quo. And because the volumes are so low in commercial vehicles, the OEMs have a real problem with it. Because an OEM, to develop a new platform, and we have constant conversations with Ford and GM, they say a new platform's about $1 billion. We can say we can do one for $500 million, but it ends up being $1 billion. So when they're honest between, off the record, they tell you things like that. They wouldn't tell you that on the record. So it takes small companies and early stage companies to get these kind of sectors going. And yeah, this year, so we'll do with Lightning, we'll do about 5 million this year in sales. And we've got the order input to do 30 million next year. So yeah, when these things start moving, the growth is pretty phenomenal. So this is what we're raising right now, and this was actually a slide I put in to go back a bit to Greg's point about alternative infrastructure lending. On our last round at Lightning, where we're just bringing in 1 million of equity, we've also been lucky to work with an infrastructure fund here in Denver called AMG National, and they provided us $1 million in equity and 20 million in a loan, in a very originally structured loan that actually helps. It's a PO funding, so the borrowing base is calculated based on our order backlog and our accounts receivable, so really matches the company's requirements in this case. So it is interesting as you can pull in others. Another company, one of my other favorite portfolio companies, a company called Boulder Industries. We operate the world's first a real tire recycling plant. What I mean by real tire recycling, I mean you all have heard of tire recycling, and really what it is old tire repurposing. It shouldn't be called recycling. For those of us in the business, we view that as offensive, the way it's been called recycling, because basically you shred the stuff and then you put it on children's playgrounds and stuff like that. And by the way, the emissions from it is pretty horrible, so don't let your kids play on those kind of playgrounds, not healthy. We, on the other hand, we take the tires, we shred them up, we put them in pyrolysis, so we heat them to 200 to 2,000 degrees Fahrenheit under vacuum. So the EPA says we are a non-emitting factory. So we have, you could put this in the center of Manhattan and it would be better than the diesel delivery vans we were talking about before. So we have the first industrial scale one. We will be producing, we will be taking in about 3 million tires this year and converting them. It's the interesting thing. I've just got, okay, give me 2 more minutes. The interesting thing is it generates energy. Reclaimed oil, which is used for energy obviously also. And then the biggest thing it generates is carbon black, recycled carbon black. And the real challenge there is how you do that. Now, again, going back a bit to the financing, what's been the problem in most of these advanced technology waste conversion plants is they've been forced pretty much to just use VC equity to fund them totally. That's been how 99% of them have been done today. We were the first ones who managed to bring in project financing in the proof of concept plant. That was really, from a structural point of view, our where we succeeded where everyone else had failed before us. What that means is when plant 2 comes, which is then the first industrial plant, the ownership at the top has been considerably less diluted. So the return for the investors who took the real big equity risk up at Boulder Industries is way better protected. And also, I don't really care as an investor what % of the proof of concept plant I own, because that's at best going to earn a 10% EBITDA. Once we get to plant number 1 and we figured out the real industrial plant, then the EBITDA is about 35%. Because interestingly enough, in these tire recycling, we sell all the resulting products, but we also get paid to take the tires. So you have zero raw material costs, and you get paid to take the raw material. So that's how you get to a 35% EBITDA. Hope that was of interest.
Thank you very much. As a moderator, I'm going to ask a few questions first, and then we'll open it up to the floor. Can everybody hear me? For Ambassador Bob, you mentioned the LNG project in Mozambique. What are some of the challenges that these partners face?
I think that one of the major challenges they face is sort of geographical. In terms of the size of Mozambique, the capital is in the south, the project is in the very north. So for corporate people moving back and forth, for supplies moving from the south up there, for bankers to go up and check everything out. So Mozambique's coastline is 1,534 miles. The west coast of the United States is 1,293 miles. Imagine the capital of California being in San Diego and the project being in British Columbia, and how decision makers, government people, executive branch, Congress, you're trying to sell people on the value of the project and what you get out of it to help the development of the country. So it's a basic communications and transportation problem. The corporates, they have to understand that. They have to understand what people are thinking, and they have to take them up and let them see it, address their questions, a lot of active listening, so that they package their corporate social responsibility, not on what they think as an engineer is needed, but what the people, what that mayor wants. what that senator thinks he wants for his district. So that is the type of sort of communications problem that comes that is larger because of the distances and communication that have to be covered. Now, Mozambique has been blessed with hydropower for the last 30 to 40 years with the Cabora Bassa Dam. It's now, over the last 5 years, it has been working to enhance its backbone transmission system from north to south so that that power from the dam is dispersed for more people to benefit. The U.S. government launched a Power Africa initiative in 2013. Came out of the State Department. The Assistant Secretary of State who conceived this reached to me at the Corporate Council on Africa, and we took a trade mission with several USG agencies and companies involved in the power sector in emerging markets with us. Introduced them to presidents, prime ministers, to corporate partners in country, so that you begin a dialogue for investment in the power sectors in the countries visited that has played out over time. The companies realized then that they had the support of the U.S. government for going into risky markets. Mozambique is risky. They've still the political consequences of the war of independence and the fight between the governing party and Renamo. They just signed a peace treaty again about 5 months ago. So these tensions are there. And so you have to work through that. We went to Mozambique, Tanzania, Kenya, Ghana, and Nigeria to kind of tell everybody that we were going to help. USAID became the prime agency to send in policy advisors to work in the capital of each of those countries to help the decision makers, generally the Minister of Finance and the Minister of Power, design systems to attract investment, regulations so that everyone knew what to expect, and then a sort of a transparency process to be sure things were followed. So it was the USG that provided the technical assistance to help countries set up systems to get the power they needed for economic growth. With that in Mozambique now, there's the opportunity. You can't do everything from the central grid. So lots of opportunities for off-grid power. GE, I know, has been doing off-grid power in a number of countries in Africa. There are agricultural projects in Mozambique sponsored by American companies. They need power. So you can find corporate customers there to defray the cost and not have to solely depend upon household revenue.
Thank you very much. Now, I have a question for Greg. You mentioned that it's important for your investments to have expert knowledge, such as the intellectual capital that you've seen here at the conference. How important do you believe that an expert opinion or proof of concept is needed when you start an investment? And then I also want to follow that on with, do you look at both pre-revenue and post-revenue projects?
Sure. So our reliance on experts depends to some extent on the nature of the project. Certainly if something is an emerging technology, we are going to be dependent on experts tell us that the technology actually works. We may be dependent on, let's say, power price forecasts, and we'd be reliant on experts for that. And then the demand side, how we see people adopting, let's say, electric vehicles. It's fascinating to me that split that you were talking about, Robert, that, you're going to sell 1,000. So it's exactly that sort of thing. We could be looking at We could be looking at an electric vehicle charging opportunity that's designed for trucks, and until somebody that's expert in the area tells us, yeah, we only sold 1,000 last year, we wouldn't know. So I think relevant to the people that are at this conference, and especially with all the academic weight that's here, I mean, helping us make the case to our investors to support these technologies, and bearing in mind that they're not paying us to take the sort of risks that Robert's investors are taking. They're paying us to find things that we can finance in the sort of 5% to 12% range. So, and they expect us to go out, pay what's necessary to get experts for all of the various aspects of the project, and in particular sniffing out what could go wrong and figuring out how large the downside risk is. To answer your question about pre-revenue, we do pre-revenue. And I'm glad that you use that term, because it's not just construction risk. We do construction risk, but we have a limit of no more than 20% of our fund invested in pre-revenue contracts. And pre-revenue is important because a lot of these projects will have what we refer to as ramp-up risk. So the thing is operational, but usually the ramp-up risk, it can mean operations. As they get the operations bedded down. More often for us, when we say ramp up risk, it's users and hence the user revenue. So if we're going to go into a project like that, we need to build slack. We might have reserves, cash funded reserves, or in our case, we more likely would allow them to what we call PIK. It stands for payment in kind, instead of having to pay us cash interest. So during the construction period, there's no revenues. So you would ordinarily PIK during that period, but allowing our borrowers to PIK even during a ramp-up period is just prudent. Nobody wants a default. They don't want one. We don't want one. So we do have capacity for pre-revenue projects. It is limited to 20%, and if you remember that graph that I showed in my presentation of project financing having a declining marginal default rate, investors are aware of that. And that's why we can have 20% of the portfolio with the high default in those early years, but we are subject to that limit.
Great, thank you very much. And then I have a question for Robert, and then I'll hand it over to the floor for questions. Robert, you mentioned for your Lightning project that you're in the commercial EV business, but how is that different from the passenger car EV business, both from a technology and infrastructure standpoint?
Thank you, Tina. As I mentioned before, the shocking difference today is that in this year there'll be 500,000 new electric cars and only 1,000 new electric buses and trucks in the U.S. So, those